Hey guys, welcome to this week's episode of the Four Horsemen Real Estate Podcast. Today, we are going to talk about some of the recent data that indicates a notable rise in mortgage delinquencies across Ontario. We're also going to get into some of the impacts on Millennials and Gen Z and how they've added $1 trillion in additional debt. And then finally, we're going to talk about the tariff wars, dun dun dun, and what the Bank of Canada is really telling us. Equifax Canada's credit trends report reveal that over 11,000 mortgages in the province have missed a payment, nearly tripling the figures from 2002. The 90-plus day mortgage delinquency rate, that surged by 90.2% year over year. This uptick suggests that more homeowners are struggling to meet their mortgage obligations. Duh, no surprise. Obviously, that's what it means. But that trend hasn't been this pronounced since before the pandemic. Several factors contribute to this development. Okay, let me just read a piece here from TransUnion from their report on Q4. Here's what they say. Credit participation grew by 2.5% year over year, with 32.3 million Canadians holding at least one open credit product, a trend fueled in part by recent decline in interest rates and inflation. Okay, now this is for the Millennials and the Gen Z. Millennial and Gen Z consumers were at the forefront of this increase, collectively holding 1.1 trillion in outstanding balances, a rise of 10% year over year. Gen Z consumers were the fastest growing segment, with a 29% increase in credit participation as they diversified their debt beyond credit card debt. Okay, I've got something interesting for the Gen Z and Millennials. How do you know if you're Gen Z or Millennial? Here we go. Millennials, anyone born from 1981 to 1996. Gen Z, 1997 to 2012. Why do the Millennials and Gen Z on their own have $1.1 trillion in credit card and other types of debt? We have a new form economic system that's come online really since the 80s. It started blowing up, and this is why it affects the Millennials and the Gen Z so much, because they've not really known the system before. That system is a credit-based economic system. It's an economic model where credit, rather than purely money or physical currency, cash dollars, plays a central role in the facilitation of everyday transactions, investments, and overall economic growth. For a millennial, anyone born after 81, you were not used to carrying cash in your pocket. Once you got to the point where you had your own, you got used to having credit cards in your pocket, debit cards in your pocket, and using a credit-based economic system. Okay, what's the other piece of this that we're trying to understand? Yes, we're now talking about these different levers that are being utilized in the system. Consumers, by and large, use credit. They use loans, they use credit cards, mortgages to purchase homes, cars, and other goods, often paying them over time. Why are Gen Z and Millennials acquiring so much, trillions of dollars of debt? And why are they not using savings? Is because they have been disincentivized. Yes, they've been penalized for saving money. When you keep cash in the bank, you're going to get penalized because the price of goods, what we call inflation, is going up faster than the amount of money they're making by keeping it in the bank. The old people, the people back in the day, if you didn't have it, you didn't spend it. Well, that's not the system you have now, and the market will always rise to whatever you're willing to pay. I'm sorry, Millennials. I'm sorry, Gen Z. That's just the reality of market economics. Tiff McCallum gives us a dose of reality here.
Incomes will be lower in Canada. And unless we introduce a new structural shock, some structural reform that boosts our potential output, but boosts supply, there's no bounce back. What that means, for monetary policy, we can't change that reality. The economy is going to a permanently lower path.
He's actually giving you some honesty here. Notice this is not a prepared response where he's trying to motivate you, calm you down, any of those kind of things. If you don't know what he was trying to explain, he said that if we get into a tariff war, it will put real constraints on the Canadian economy. In fact, he said it will slow down the economy indefinitely. Why will it do that? Because our natural response from the Bank of Canada is to lower or raise interest rates. If they lower interest rates, we know that that means that people are going to borrow more money. Every time you borrow money, you are creating more cash. That inflates our overall economy. If they raise rates, then of course there's less borrowing, there's less investment. And so in either of those scenarios, the Bank of Canada can be severely restricted. If they lower interest rates, we could go right back into an inflationary cycle where we watch what happened over the last number of years, the last couple of years. If they start lowering interest rates too far, yes, it makes it a little bit easier for us to borrow, but it also means the cost of everything will go up. And that's the challenge that this trade war, this tariff war could create. Unless we start finding other partners to sell our stuff to other than the U.S., unless we go out and start creating other alliances with other countries so that we can sell our goods. Here's the challenge with that, guys. It does not happen overnight. If this gets into a protracted trade war, tariff war, it could take years. It could take another 5 years to be able to come out on the other end where things balance out. In the meantime, we could go through a huge rush of inflationary economics, just like we did. But these are all important factors for you to take into account, not to be scared of, but take into account when you're taking on additional debt, when you're going out and buying new Jordans and Gucci bags. Understand the impacts of what we're about to go into. And if it doesn't happen and Trump pulls back and we don't get into this tariff war, you'll be excited that you had more cash in the bank. Get yourself ready. Yeah, because the Bank of Canada is telling you that they will not be able to rescue us if we get into a tariff war.
Trust in their word, they walk the talk in the world of investment, they make their mark.